Let's talk about the state of the housing market, not only here in Phoenix, but nationally. What do we have going on? Because the truth is, depending on where you live, things look quite a bit different. Even in the Phoenix area, there are some cities performing much better than others, and you might be feeling something different depending on where you're at, whether you're a buyer or a seller, etc. We're also still in a government shutdown, and mortgage rates have been affected. We're going to talk about where those are at and what the forecast for those are in 2026. So let's start with this article from Redfin. Okay, home buyers are scoring the biggest autumn discounts since 2019. That sounds pretty awesome. But again, this is going to depend on where you're located. So from a national standpoint, I was just hearing from an agent who is on the East Coast. Sounds crazy over there, like a frenzy. Multiple offers, tons of showings on properties. I can attest to you that that is not what we are seeing here normally. Unless you're pricing your home pretty low, we're not seeing that type of situation here. So it really depends. But according to this article, they're saying that the typical home that sold last month went for 1.4% less than its final list price, the biggest September discount in 6 years, as a slow housing market empowered buyers to negotiate. I want to compare some of these stats to what we're seeing in Phoenix. So let's go through these really quick. The typical home that sold spent almost 50 days on the market. Also, they're saying that's the slowest September pace in nearly a decade. Existing home sales inched up to the highest level in 8 months, but pending sales, which gauges demand a little bit more currently, fell from both a month and a year earlier. They're also saying that sellers have started to pull back in response to sluggish demand, and active listings fell roughly 1%. Some of this is different than what we're seeing here in Phoenix. So for example, our sales price to list price ratio here is about 97.5, almost 98%. So we're seeing homes sell for roughly about 2% less than the list price in the Phoenix metro area, which is a little bit more than what Redfin was reporting on a national scale. Also, keep in mind, this is really looking at the last list price that the home was listed at before it actually went under contract and closed. So truly, there could be a bigger gap between what it's listed at and what it actually sells at. By the way, if you're curious of what that sales price to list price ratio looks like in your city, check the description below for more information. They said about 50 days on market is what they were seeing. When we look at Phoenix Metro, we're at about 41 days on market. So actually trending a little bit better than the rest of the country, according to that Redfin article. Now, I will say they did not say whether that's average or median or how they were measuring that. This is being measured at contract. So this means that homes on a median basis have been on the market 41 days before they actually receive a contract. And then typical closing time frame is about 30 days from there. So as a seller, you can think about that median looking a little bit more like about 70-ish days from actually listing to closing on the home. Typical for this time of year, but it's just going to depend on how many listings actually come on the market and whether or not the demand actually keeps up with that. If it'd be helpful for you as a buyer or a seller to know what the days on market is in your location, check the description below to request that info. Now, this Redfin article also calls out the share of homes selling above list price. So if you can believe that, that is still going on. Again, not something we're seeing as much in the Phoenix metro area, but they say 25.3% of homes that sold went for more than the final list price, which is down from 28.5% a year earlier. So, not that much of a change from last year, but still very impressive to see that homes are selling over their list price. Now, you might be surprised to see that we are tracking some of that here as well. A lower number, we're at about 14% of homes are selling over the list price in the last 30 days. So it is happening here, but again, this is all kind of relative, right? Because if you price a home for $500,000, but it's really worth $550,000 or $580,000, then yeah, you're probably going to get a sale above the list price, right? Because people can recognize that you may have a bidding war, multiple offers, and end up selling above the list price. It doesn't really mean that the house was priced correctly from the start. And the same can be said for homes being sold under the list price. We can have very optimistic sellers that start too high and the home was never going to sell at that number number anyway. So of course it's going to go for below the list price. So there's a little bit of that to consider when we're looking at these stats, but still impressive to know that 14% of homes are selling above the list price. Now, like I mentioned, every area is a little bit different, and this does not have to do with Phoenix, but I did want to share home sellers in these 5 metros are seeing profits as high as 60%, which is pretty impressive given that we've had such a market shift since the pandemic years in the real estate market, but some metros are still very, very strong. These 5 metros had the largest annual profit gains in the country: St. George, Utah, Gulfport, Mississippi, Augusta, South Carolina, Lexington, Kentucky, and Dayton, Ohio. The typical home sale netted $123,100 in raw profit in the third quarter of 2025, up 1.9% from the previous quarter, according to Adam's latest home sales report. Now, other than St. George, Utah, all of these are more East Coast versus West Coast, which is where we're typically seeing a little bit more activity in the real estate market anyway. So I'm not super surprised, but still the strength in the market in some of these areas is just so much different than what we're seeing here in Phoenix. Now, a little bit more of what we're seeing in the Phoenix area is related to this Redfin article. New listings creep up as would-be homebuyers back off, haunted by high prices and economic unease. I would say that's a little bit more of a descriptor of our Phoenix market in most areas. They're saying new listings of U.S. homes for sale rose 4.1% year over year during the 4 weeks ending October 12th, which is the biggest increase in over 4 months. Most sellers are entering the market because they're hoping lower mortgage rates and small improvements in affordability will attract buyers. The weekly average mortgage rate is 6.3%, just shy of its lowest level in a year. That's actually a little bit dated, and we're going to talk about where rates actually are today. But this is definitely something that we are seeing in Phoenix a little bit. We are seeing the listings start to increase. A lot of buyers that were hopeful that rates were coming down much more significantly than they actually are, and are still sitting on the sidelines, whether they either want to or they just feel forced to because they can't afford otherwise. They're also saying that pending home sales are falling 1.2% year over year, and the typical home is sitting on the market for 48 days before going under contract, a week longer than last year. We just talked about some of these stats, and while it is a longer period of time than previous years, it's still in a very reasonable amount of days on market. We have to remember that where we're at today is much more reflective of a balanced market and in some areas a buyer's market. But for the most part, this is a healthy correction as compared to what we were seeing, in the early 2020 timeframe. So let's talk mortgage rates, where they're at, what the forecast looks like, how this is affecting our market. By the way, if any of this is helpful for you, consider subscribing and sharing this video with someone who would appreciate this information. Mortgage rates won't fall below 6% anytime soon, a top economist says in Grim Forecast. I talk to a lot of people who will say, I'm waiting for rates to get to 5.5%. I'm waiting for rates to go back to the 4s. And I gotta say, I'm with this guy here. I don't think we're going to be seeing anything under 6 for a while. I certainly don't see anything in the 4s coming anytime soon. Hard to predict, but according to MBA chief economist Mike Fratantoni, if I said that correctly, presented the forecast at the group's annual conference in Las Vegas on Sunday, projecting that 30-year fixed mortgage rates will remain roughly in the range of 6% to 6.5% through the end of 2028. So that takes us through the next 2 years, not even getting below 6%, according to his forecast. So he predicts that the Fed will cut its short-term policy rate twice more in 2025, but only once next year as concerns about inflation force the central bank to halt its cuts. Growing government budget deficits and elevated inflation expectations will keep longer-term rates from falling further, even as the Fed cuts short-term rates this year and next. So that would keep the 10-year Treasury yield above 4% and mortgage rates between 6 and 6.5%. So that is how he's kind of come to his prediction with all of these other factors in mind. Now, he does say that mortgage rates are not expected to decline further, but housing supply has increased in recent months, which will ease home price growth and provide more housing options for prospective buyers. This will put downward pressure on home prices across the country. We predict that home prices will decline nationally for several quarters over the next few years before returning to modest annual growth in late 2027. So we'll see what happens from there. I'd love to hear from you guys in the comments. What do you think? Do you think rates are going to stay above 6? Meanwhile, there will be enough pressure on prices to come down. I know there's the ongoing argument. Is it rates? Is it prices? Is it both? And many people have very solid opinions on that. So I'd love to hear from you in the comments on what you think. This Housing Wire article is pretty interesting, saying what the latest mortgage data tells us about home sales in 2026. So they say the landscape is changing for mortgages. Average rates rise above pre-pandemic levels, impacting homeowner behavior and the housing market. With more homeowners holding expensive mortgages, the market is seeing increased turnover and potential sales growth in 2026. So we've talked a lot about the lock-in effect, which has been easing because people end up having to actually sell their homes regardless of what their rate is. As much as they want to hold on to it, there's other factors that, force them to move on, right? And so we're starting to see this shift. That's kind of what this article is talking about. The average interest rate on all outstanding mortgages in the US is now 4.3%. You might be surprised to learn that by the end of the year, the average rate will be higher than the levels of Q1 2020 before the pandemic boom. For the average American mortgage holder, the incredible gains of the pandemic mortgage bonanza have essentially evaporated. So they're saying there's now the haves and the have-nots. There are as many mortgage holders with rates over 6% as there are mortgage holders with rates under 3%. About 20% of all mortgages are in each group. So it's pretty interesting because we definitely had a much larger chunk of people with rates that were super low. And because if you already owned a home, you refinanced when rates were low. And then if you were buying a home, you got a great rate. And now we're starting to see that shift. And so they're predicting that this could affect the housing market in terms of turnover, because the more we start to see people not, being so married to their rate, the more they're going to be willing to actually move, sell if they have to, and, trade homes essentially. The rate's not necessarily holding them back. They say homeowners who have a higher mortgage rate are less likely to hoard the property. Higher rates mean investments are less profitable. It means holding costs are higher, and therefore the house is more likely to be resold. They're also saying that we're paying off our mortgages very quickly. The loan to value ratio for all outstanding mortgages in the US is now only 44.2%. That means the average American homeowner with a mortgage has 55.8% equity in their home. Beyond that, approximately 40% of all homeowners in the US own the home free and clear and have no mortgage at all. So it's pretty interesting to analyze the shift that we've seen in rates, how much they really have impacted our market as they've driven people to jump in because they were so low, and now have prevented people from jumping in because they are on the higher end in combination with where prices are at today. Now, with the government shutdown, we've not anticipated a lot of volatility in the mortgage rate world. However, where we stand today is pretty low. We're at about 6.17% for that average 30-year fixed rate. The last time we were here was the beginning of September, 6.13 at that time. So very close to that obvious, dip, obvious low that we had, and going all the way back to, November, October of 2024 last year. We were much higher, 6.85%. These are the lowest levels that we've seen since then. In fact, they're saying that mortgage rates are near 3-year lows today. So last week, we actually ended the week with rates at the lowest levels in just over a month, but it was the third best day in over a year and the 24th best day in over 3 years. We're hanging around 3-year lows with minimal volatility. Now, I know many of you out there, if you have your home on the market or you're planning to list your home, are thinking this is great news. This is bringing buyers out. But I got to tell you, I'm not seeing that much increased activity from this rate decline. Now, don't get me wrong, the market is still moving, but I would say that we're definitely more in a balanced range which may be teetering on a buyer's market depending on your location. And it's really, these rates just aren't moving in a direction that's getting people to jump off the fence right away. If we take a look at where we're at with the Cromford Market Index, just a reminder, on their index, anything between 90 to 110 is considered balance, and we're sitting at 78.8. So technically across Phoenix Metro, we are in a buyer's market. Supply is right around 100, which is that normal range. It just tipped over 100 to 101. And demand is about 20% below normal at 80.2. So across the board, we're seeing less demand than supply. And as you saw, the active listings on the market continue to climb. Demand not really keeping up. And so the further that those two get away from each other, the more we will be in a buyer's market. Now, across the board, everything is a bit different because we do have Fountain Hills, Paradise Valley, Scottsdale, Chandler, Gilbert, and even Avondale, technically, all in more of a seller's market environment. Everything on this list from Cave Creek down to Tempe is considered a balanced market, and then Peoria all the way down to Maricopa considered a buyer's market. But you can see all of these are mostly red arrows, meaning that they're moving away from a seller's market, more towards balance or further into a buyer's market. And each month over month percentage change is a little bit different. We're seeing a pretty big move with Avondale and Cave Creek at 10%, negative 10%, and negative 13%. The average month over month change for all of these cities this week is negative 2.8%. Last week, negative 1.1%. So we are continuing to, lose the ground for sellers across the board. So where do we go from here? It's anyone's guess. The fall tends to slow down a little bit. We still have a window of time before we hit Thanksgiving and start to see some of the slowdown here in Phoenix Metro. So we'll see what happens with rates, with inventory, with demand, how long this government shutdown continues. There's a few question marks as we round out the year. But if any of this information is helpful for you, check the description below to request it. Also, if you just want to chat with our team to understand what a good move is for you, whether you're thinking about buying or selling, check the description to book a discovery call with our team. I will see you guys all next week on my next market update.